So I am long-term bullish on Bitcoin. I don't really have a view on the next 6 months or so because if you look at what drives Bitcoin in short and long term, it's quite different. So short term, Bitcoin is one of the tightest liquidity plays. So, and there's different ways to measure liquidity. Like cross-border capital has their liquidity metrics, and Bitcoin tends to follow them pretty well. There's also like if you just take global M2 and you denominate it in dollars, and you look at it in year-over-year rate of change terms, generally Bitcoin's price is pretty correlated with that. So obviously that's taking into account both the dollar index and just the rate of broad money supply growth globally. So, when people say it's an inflation hedge, what it actually is kind of is a money supply growth hedge, and that tends to precede inflation, which is why you had money supply growth and Bitcoin go up together. And then when central banks tried to stop money supply growth and tried to raise rates, that's actually when a lot of assets, including Bitcoin, ran into headwinds. And so, I am long-term bullish on Bitcoin. I like the fundamentals, for lack of a better word. Obviously, it doesn't have cash flows like gold, but basically it has use cases. And when you look at the use case of something like Bitcoin, gold is useful, but you can't really bring it globally. Right? Whereas Bitcoin, you can memorize 12 words and you can go anywhere in the world and you can then re-access your Bitcoin eventually. And so that it's kind of this like shared global ledger that anyone with an internet connection can access, which is at this point more people in the world than have bank accounts. More people have smartphones than bank accounts. And obviously it's got over 90% of the proof of work market share. It's got still the largest market cap of any cryptocurrency, just the most decentralized, and so I'm quite long-term bullish on it. You just have to have if you have like a near-term view on it, you have to have a view on liquidity, whereas long-term is more about fundamentals. Like, do more people want to hold this versus now, or do less people want to hold it? And I think the fundamentals point to more people wanting to hold it. I also pay attention to the startup ecosystem. I do a little bit of VC investing in the Bitcoin startup space, and so I look at companies that are building on top of Bitcoin, making use of Bitcoin, and those are still doing quite well. And they have a lot of really cool products that are coming out in the months and years ahead. And so the network keeps getting easier to use, more useful to use. And to your prior point about spending, the way that I kind of view it in phases. So when Bitcoin is in its adoption phase, which is basically that it's, that it's below its level where if everybody understood Bitcoin, what percentage of them would want to hold Bitcoin? I don't think we're at that level yet. I think that it's still an underappreciated, understood asset. And so in this kind of low adoption phase where most people don't hold it, those that do mostly don't hold meaningful amounts of it, I think it's kind of in that sort of investment speculation phase where you're kind of analyzing the network, you're envisioning what could be, what is likely to be, and you're holding it mainly for that reason. And what you're kind of holding is a sort of ability to make payments should you need to, right? So maybe you don't want to buy your coffee with it now, but the fact that if you hold Bitcoin in self-custody, you can bring that anywhere in the world, which you can't do necessarily with your equities, with your gold. And for us in the United States, that doesn't seem like an important trait. But for Nigerians and for Argentinians and for Lebanese people and for South African people and for Vietnamese people and for people around the world, that's a pretty powerful trait. That global portability of an asset. I think when we think globally, that's the use. And as it eventually reaches, I think, a larger adoption, more liquidity, less price volatility, then it becomes more useful and interesting as a spending currency. Even now, there are things like, for example, there's a protocol called Nostr, and you can use it to build things like a decentralized Twitter, and you can use it to build other things, and they can all interact with each other. So kind of like how, like if I use Gmail and you use Yahoo Mail, I can send you an email because they both use the same underlying protocols. Like right now, Twitter and Facebook don't really talk to each other. Whereas with something like Nostr, you can have different social media ecosystems and clients that actually talk to each other. And one of the things that Nostr does, for example, is they incorporate Bitcoin Lightning tips in a similar way that Twitter has likes. And so you can just, with the click of a button, send someone Bitcoin instantly. And it uses the second layer on Bitcoin, which is called Lightning. And it just does that super quick. And you can use whatever wallet. You can use a custodial wallet. You can use a non-custodial wallet. And so you have all the different ecosystems sending signals, monetary signals to each other, and I think it's kind of neat because it's like when you have identity and money, like identity and a wallet mixed together, like anyone on Nostr, I can send them money in 10 seconds. Whereas I can't do that. I have friends and I have to say, okay, what is your payment details? What is, what platform do you want me to use? Things like that. Whereas I think the value of this kind of digital money is that you can have these combined identity and wallet services or protocols, actually not really services, but open source protocols, and make use of that over time. And I think that one of the things that this opens is that when you have less friction of cross-border trade in kind of a global unit, it opens up, I think, a lot of really powerful workers in countries that have just kind of been underrepresented in the global field, and kind of results in more globalization of white-collar work than we've seen. Whereas, when we think of globalization, we think of outsourcing, we often think of manufacturing. But I think there's a lot of creative professionals and engineers and programmers and graphic designers and things like that around the world that now with this type of technology are more interconnected with the rest of the world. Like one of the companies I work with in the startup space, for example, they have employees or contractors in Argentina and like Lebanon and Turkey, and they pay them with Bitcoin because it's easier to do. And so it's not something you necessarily want to use all the time, but there actually are circumstances where paying with Bitcoin makes sense. So I think the things you listed are relevant. So Greek technicals, all sorts of things like that. I would also add liquidity. And so when the central bank responds to a crisis with some degree of liquidity injection, even if it's not permanent liquidity, it's just more money in the system, that can be good for a lot of asset prices. Also, it changes our forward expectations of how hawkish the Fed's going to be. And so you kind of have that good news is bad news reaction, assuming that asset in question is not part of the bad news. So if banks are blowing up, then people say, well, I guess that means tech stocks have a green light because the Fed, it kind of limits the tightness they can do, and therefore those longer duration assets can catch a bid. I think that's kind of the thought process we see in the market. Now, I think the bearish case would be that they're underestimating earnings slowdowns, and that would obviously affect the fundamentals of those companies if they were to slow down materially. But one thing I would kind of back up is if you look at if you go back to the idea of a somewhat inflationary decade, and a decade that's especially driven by fiscal driven inflation. One thing is if you look at emerging markets, equity markets, when they go through a recession or a currency problem, their equities often do decently in nominal local currency terms, even though they're doing poorly in dollar terms. Because if you have a stagflationary recession or an inflationary recession, nominal prices aren't always the best signal. It's really kind of the real numbers. And so I think stocks have been doing pretty poorly in inflation-adjusted terms since the end of 2021. They've obviously not been doing great in nominal terms either, but it's even worse in inflation-adjusted terms. And so my expectation is that stocks are not going to have a very good inflation-adjusted 5+ years performance. I think this is likely to be somewhat of a lost decade in inflation-adjusted terms, or priced in gold, or priced in a basket of commodities, let's say, right? So I think when you have a harder unit and you're measuring what equities are going to do this decade, at least in aggregate, I think it's not attractive. In 2021, not only did you have high classic valuations like Shiller PE ratio and market cap to GDP, another metric I like to look at is household assets as a percentage of the total assets, right? So in 2009, partly because of valuation contraction and partially because of people pulling their money out, they were underexposed to equities compared to their average. Whereas in 2001, both again because of valuation increases and because of heavy allocations, investors had record high exposure to equities. And so there's really, in my view, not a lot of marginal capital that can come in and keep just grinding to higher and higher valuations. Even if you might reclaim nominal highs at some point, I don't really expect that to happen anytime soon, but it's certainly possible. But I think that the problem is that as a percentage of total assets, and in inflation-adjusted terms, equities are probably unlikely to do very well, but that they might still do better in nominal terms than the bears expect when you have that kind of just ongoing cyclical inflation problem.